Right, hello and welcome to Camel Finance. I'm your boy Camel, and first of all, I'm feeling a lot better. So thank you for all the well wishes. I really appreciate that. Today, I want to talk a little bit about Bitcoin, right? And then I'm going to talk about M2 because I saw something at M2 that at first made me laugh because the thing that was presented falsely or erroneously, and then it made me feel quite sinister. So I'm going to go over this, but before so, I got a few nice things to show you about Bitcoin. First of all, the level of SEC engagement, back and forth changes on the Bitcoin ETF, tells Bob Lucas that it's 99.9% a done deal. So happy days there, I guess. I found yet another chart that suggests, this time using Hurst cycles, that we may well see a left translated cycle top followed by an extended bear market decline. So it's not something I want to see, but undeniably, there are more and more signs under the hood that continue to point to this. Of course, if we were to base here or pull back, then we can scratch this one off as an idea. But if we continue to stay in up-only mode, okay, then this becomes more and more validated. Not to mention, we've got yet another sign that is firing off, that is suggesting that we are staring down the face of a parabolic advance. Again, last time this signal fired here and here, what we saw was a parabolic curve unfold. Is this time going to be different? I personally doubt it. Again, I'm open to being wrong. I want to be proven wrong. But for me to be proven wrong on this, then we need to see basing or a correction back down towards the lows. So far, haven't seen either of those things. As of the time of recording, we're only about $8,000 away from that magical $1 trillion market cap, which currently sits at 51k. Bitcoin, silver, you can see the market cap of silver right here. So we're only about 60% away from taking out the value of silver. That is significant. So Bitcoin is going to continue to do Bitcoin things as far as I can tell. And so from Bitcoin to slightly more sinister things here, okay? Now I say this not to be a doom and gloomer. I'm simply pointing at things and trying to solve a very complex puzzle. Now, this was the slide I was talking about at the start where I said when I first saw this, it made me laugh because, as you can see, warning, M2 supply has collapsed and it's now contracting at the deepest level since 1960. Now, this made me laugh because it's just completely wrong, okay? It's completely wrong, and David Hunter here sums it up perfectly. The money supply has not collapsed. The growth rate of money has collapsed, okay? This is measured year over year, so you're mesmerized by a chart and you really don't understand what you're looking at. As a result, you're drawing the very wrong conclusions. And it's true, we are drawing the very wrong conclusions here. So I'd like to just quickly touch on this and draw what I believe to be the correct conclusions. If you've been on this channel before, you will have seen me draw this inflation to deflation pendulum a bunch of times. We are no longer here. We have gone through the Goldilocks zone in the middle and are somewhere in this neighborhood here, if I am correct. Now, the reason I say that is, first of all, back to this M2 rate of change, which again, I've shown multiple times, right? We're only here, and M2 rate of change lags manifestation in the US CPI by somewhere in the neighborhood of 18 to 19 months. So right where we are at the moment, this level of M2 rate of change corresponds to where we are with the CPI print currently. We're getting this little bit of wobble that, like I said, corresponds to this little bit of wobble in the M2 rate of change. But in the real world, the M2 rate of change has fallen off a cliff, as you could see from this slide right here, okay? So we are currently only seeing this level of manifestation in the inflation prints, when really all of this is yet to present in the CPI readings. So if I go back here, you can see this is where we are, corresponds to here. All of this is yet to manifest, and that's why I continue to expect that we have indeed swung from this highly inflationary to a deflationary environment, and it just hasn't shown up in the data yet. This is also the reason that on this channel, I believed, whilst we were in that Goldilocks zone, whilst we were in the middle here, things don't look so bad. Inflation is coming down, we can see the light at the end of the tunnel for rate hikes, and this is where the market will rally. So far, the market has indeed rallied, and we can tick that one off. But of course, if this thing is going to continue to play out, if that pendulum is going to continue to swing, then we may well be a mere few months away from seeing a rollover in what could well be a deflationary bust scenario. Now, again, as always, I'm never trying to predict anything. I'm just having a base case, a hypothesis, and then seeing if I can stick with that hypothesis until it is proven wrong by the market. My job is not to be right or wrong. My job is to simply allow the market to tell me which side I need to be positioned on. But going back here, when I said this actually has sinister implications. First of all, the implications are, like I said, that we may well be looking down the barrel of a deflationary bust in the not too distant future, as illustrated by this arrow right here. But M2 also has a much more sinister implication than that. So allow me to explain. M2 is what? It's deposits, right? That's what M2 is. And what we're really seeing from this chart, which is falling off a cliff, right? What we're seeing is deposit flight. So before I explain why this is so bad, I think it's important to set the scene here. Remember, the Fed told the banks to buy bonds and it promised that it wasn't going to raise rates, only to then go 3 weeks later on the most aggressive rate hiking cycle that the world has ever seen. And in doing so, it forced the banks to sit on a bunch of unrealized losses from those bonds that it had been told to buy by the Fed under the pretense that it would not raise rates. So these banks are now sitting on massive unrealized losses from these bonds. And the only reason that we haven't seen more bank blowups is because they offered a couple of ways to quote unquote fix this problem. The first was the mark to market, and the second was the bank term funding program. Now, this whole mark to market thing is equivalent to me buying one Bitcoin at $30,000. It drops 50% to $15,000. And instead of me say, well, I've got a 50% unrealized loss, I just say to myself, well, actually, I'm not going to mark it as 50% unrealized loss. I'm going to continue to mark my Bitcoin at $30,000. Even though the current spot price is trading at $15,000, I'm going to tell myself and put it on my balance sheet that we're trading at $30,000. That is what these banks have done with their unrealized losses on their bonds. They are not pricing them to reflect the unrealized losses. Instead, they are pricing them at the first price before they went into these unrealized losses. So from afar, when you inspect the balance sheets, they don't look too bad. Okay. The second thing is this bank term funding program, which remember is just the central banks printing money and loaning it to these banks in order to prop them up, because again, they are sat on these massive unrealized losses. So with all this as the pretense, okay, here's the concern. The deposits leaving the banks force the banks to realize these losses. It's all very well when there's no deposit flight from the banks, because they can continue not to price their bonds fairly and they can continue to accept loans from the Fed to prop everything up. But as soon as people start to withdraw, that forces them to sell these bonds to realize said losses. And then upon realizing the losses, the balance sheets start to reflect the reality, which of course is that these banks are insolvent. Not to mention, the bank term funding program is set to expire in March. Now, it's important to point out here that just because it's set to expire in March does not mean that they won't kick the can down the road. It doesn't mean they won't announce more QE disguised as a loan program, right, and continue to bail out these banks until such time when they start to cut rates. But it feeds back quite nicely, doesn't it? With all of this, it feeds back quite nicely into that melt-up chart. Because after we've run the all-time highs, assuming this thing is going to play out and assuming we are going to have this deflationary bust, we've had this marked here for a long time, right? Do they cut rates here? Now, of course, the CME is currently pricing that in, that we are going to see rate cuts, most probably by March. Again, more starts aligning for some kind of deflationary bust, some kind of shock into that March timeframe. And one thing that could certainly break in the meantime and force these cuts to appear would of course be if we continue to see deposits leave the banking system, forcing them to realize losses and forcing the balance sheets of said banks to reflect the true damage. If we were to start to see more and more capital leave the banks, we would likely see more and more damage appear, and thus the Fed would most probably have to embark on a very aggressive rate cutting cycle in order to bail these banks out. There's some strange poetic irony here in that they would have caused this problem in the first place, only to then massively cut rates in order to try to save them, perhaps with even more QE. And so you can see what starts off as me laughing at somebody misinterpreting some data actually becomes quite a sinister outlook. Again, it feeds back into this narrative of, are we going to get a deflationary bust? Is it going to be banks that blow up? Is that what's going to catalyze the emergency cutting cycle? Is banks blowing up the thing that is going to break and cause this emergency cutting cycle, which of course is bearish for the stock market? Technically speaking, it's also going to be difficult to know whether we're just going to get a pullback into a weekly and 4-year cycle low, like Bob Lucas has got us here, that ultimately resolves in continuation, more bull run, more bull market, more running it hot, likely more QE and higher asset prices. Are we going to continue to kick the can down the road? Are we staring down the barrel at a multi-year bull market? Or are we going to get this pullback into this 4-year cycle low and the weekly cycle low for the S&P, only to counter trend bounce, come down, undercut that low, fail, and thus are we going to get that deflationary bust, perhaps catalyzed by a banking crisis? Either way, next year is going to be wild. Next year is going to be a lot more difficult to get through than this year was. I'm convinced of that. And of course, the $1 million question is, let's assume we do get this bearish scenario. Let's assume we get this, right? And let's assume going back here that we get that failed cycle and then that opens us up for some waterfall decline. The $1 million question for me is, what happens to Bitcoin? Is Bitcoin immune? Does Bitcoin become a safe haven asset and Bitcoin starts to skyrocket whilst capital leaves the stocks? Or does Bitcoin suffer the same fate as the equity markets? Does Bitcoin continue to be treated like a risk asset? And is that what's been baked into the charts for this entire Bitcoin cycle thus far? Is this baked into the charts that we're going to have this early top followed by a multi-year bear market decline? Because if this is what's to play out for Bitcoin, if Bitcoin is not going to be immune during this deflationary bust, and if indeed we are going to see banks blow up that forces this emergency cutting cycle and takes about a year, maybe even 2 years to settle itself out, we're going to be able to look back at all these metrics that were firing early and suggesting we were going to see an early parabola and say that it was pretty obvious in hindsight that we were going to see an early top for Bitcoin followed by an extended bear market decline, the first true secular bear market decline for Bitcoin, as opposed to what we've had historically, which are these 12-month bear markets within the context of a macro uptrend. So there's nothing easy about it, right? There is nothing easy about it. Next year is going to be tough. I can tell you that right now, but we'll get through it because we can stay on the right side of the market by just having a hypothesis and letting the market tell us how to position, right? I don't have to know what's going to happen ahead of time. I just have to be able to read the charts. And that is something that I've developed over the years. So speaking of charts, not a great deal has changed since yesterday, to be honest. I noticed Bitcoin, that's probably the most significant change, right? We didn't undercut that low. We didn't get stopped out. And so far, right, we've broken out. This looks an awful lot better than it did yesterday and the day before. So happy days there. The precious metals still kind of looking heavy, still kind of looking like they don't want to break out and enter a bull market yet. So that's great because hopefully we can exit some risk into the metals back down here after we've had that deflationary bust and all correlations tend to 1. I was looking at oil and thinking this thing is kind of coming into that neighborhood where it could start to challenge this downward sloping red resistance line. So of course, all the while we're underneath this, we'll continue to push this short, right? We'll continue to push the short all the while we're underneath the red resistance line. But if we were to break out, right, if we were to do something like this, then I will be covering the short, because I will have pushed it until it became unreasonable to continue to do so. Stock market relentless, isn't it? Take a look at the stock market. So getting in that neighborhood to see a cycle low decline, we are looking for a day 38, which would be the 21st of December, through to around 42, which would be the 28th of December. My money is on seeing a sharp correction any day now into this daily cycle low, which sets us up for that rally into the end of the year. There's always the chance that we're just going to continue to push up, right? And we end up getting a much later cycle low. Remember, the cycle lows form inside of that window 80% of the time. So it does mean 20% of the time we'll get a cycle low that forms late or early. For now, though, it doesn't really matter. Long and strong continue to push. Same is true of the NASDAQ, right? Look at that, right into the all-time highs. Kind of makes sense that this is getting ready to reject or maybe just poke above and then pull back into that cycle low, and we can go. And the Dow Jones, look, still above the trend line, so we'll keep pushing this until it breaks down. Russell 2K, doing Russell 2K things, happy days there. And of course, the VIX still trading well below 13, happy days. Long and strong continue to push across the board. So that's it from me. It's pretty weird having a YouTube channel around Christmas. Normally, I'd take about 3 or 4 weeks off over the Christmas period. But since everything's rallying, then I want to continue to push my longs, right? I don't just want to hop out of the way of the market and leave gains on the table. And also, since having a YouTube channel, got to keep making some content. Overall, it has been a fantastic year. And like I said, I think next year is going to be a lot tougher to navigate. I really, really do feel that. Like I said, there's 2 possible paths, right? We can find this cycle low and we can go into a bull market, and that'll be quite easy to deal with. And then I'll be wrong. I'll be wrong, flat wrong about this next year being much harder to navigate. If that's the case, then it'll actually be quite an easy year. But if we do indeed get a failed cycle and a deflationary bust and that whole bank thing I was talking about, bank blow-ups, if something breaks, then it's going to be quite tough, right? It's going to be quite tough. But we are also going to see massive, massive opportunity to rotate out of things like Bitcoin and into gold. So overall, there's definitely opportunity. There's always opportunity. And so long as you can stay unemotional, unbiased, and willing to pivot when the market tells you to do so, then of course, there's always opportunity to make money. Quick message to the members, all those stocks look fantastic, long and strong, continue to push. And to everyone else, I hope you're doing well in life. Take care from me. All the best. Cheers. Bye.